Welcome back to Morning Trade Live. We got a little time here until about 12 minutes. Joining me, Michael Shaoul is the founder at Ion Macro Management and portfolio manager of the Ion Macro Fund. Back with us here this morning. Mike, interesting start to the week. We had a big week last week with inflation. And then we get a market trying to factor in big changes into political polling over the last 3 trading days. So where do you kind of start in your analysis of the market right now?
Lots of questions over what exactly happened on Thursday and Friday. I mean, it looks to me as if this was really a quant-driven event and something which was sparked off by the really big move in the Japanese yen in response to the CPI print, and which of course was caused by direct intervention by the Bank of Japan. So, that means there's a somewhat artificial quality to it. Having said that, the sort of extreme outperformance of the headline S&P index against the equal weight version of the index, or the Nasdaq against the Russell, I mean, the moves in the second quarter reached unsustainable levels, and so part of me says, hey, nothing really happened last week, and part of me says, there's a bit of a sort of a rubber band effect here, that you pulled so far in one direction that I think it's realistic to expect a bit of a catch-up trade by the equal weight in the Russell, whether that means the headline S&P goes down and they go up, as we saw on Thursday, or they go up more and the S&P doesn't go up that much. But one way or another, I think you should have a bit of a catch-up now.
Seems like the market almost pricing in like an immaculate landing, though, Mike. There's a catch-up trade for sure, but then there's also like this idea. We had a big regional bank rally last week. We kind of had this like feeling in the market that there's nothing really to worry about anymore. Inflation's not a problem, and also the economy is not a problem. It was almost like we're pricing in cuts without like a recessionary event. Do you think that's possible?
I think that's hard, but I also think what happened last week was you really saw what people had been shorting, because I think, let's say, the move on Thursday looked like a really, really violent quant unwind, and so my assumption is that the big rally in the regional banks had more to do with there were pockets of concentrated shorts there, and everybody had to scramble and go cover them while they cut back a bit on the sort of technology winners. So I have big questions over whether what we saw on Thursday and Friday had anything to do with people thinking seriously about economic conditions. But in general, no. I think that if we end up in an economic slowdown, what you'll see is credit problems start to emerge in some of the areas that expanded excessively. And that, our worries have been for months concentrated on multifamily real estate and to some degree private credit in general. I mean, that seems to be the part of the economy that would do poorly in any kind of a slowdown.
Okay. So, Mike, thinking about then kind of the bond market message, the bull steepening that we got from last week, it's a little bit different this morning because you've got some selling on the long end. How do we interpret bonds right now when the market's on the one hand trying to say Fed sort of is ready to cut, but then also maybe trying to say that we'll get a big like fiscal push if we get a Trump presidency? I mean, are you thinking about that right now? Do you think that's moving into the market?
Absolutely. I think the short end and the long end of the curve are completely different places to be right now. The short end will, of course, follow whatever the Fed does, and there are, let's say, reasons to expect them to cut a couple of times this year. I think that's realistic. The long end, I think that there are plenty of reasons to be concerned about the fiscal deficit. I'm not sure whether Trump runs a bigger deficit than Biden. My theory is they run different kinds of deficits, but under both parties, we get a very wide fiscal deficit. And, God help you in any kind of a slowdown, because any kind of a slowdown is naturally going to expand that deficit. So, my anticipation is that if we found ourselves in 25 or 26 in some kind of a recession, you could have quite low short-term rates and quite high long-term rates, a much, much steeper yield curve than I think people would expect to see. So I think it's hard for long-term yields to get below 4%. And so you get down to 420, 415. I'm not sure what you're hanging around for.
And so would that then be coming from term premium, the type of steepening you're describing, if it's deficit related?
Yeah, it would absolutely be term premium, related. And I think for it to happen, it would have to be a kind of global phenomenon. I do think that long-term rates, for a lot of people are a sort of relative return trade. But I think if Japanese yields break out, it's much more likely for US yields to follow. And if US yields break out, it's much more likely for European yields to follow. So we may enter an environment of quite low short-term policy rates and quite high, not historically high, but high for what we've been used to for the last 15 years, longer-term rates.
Okay. Mike, thinking about the parts of the market you want to be in, take me through it. I think our conversation oftentimes kind of centers around housing. Seems like a good place to start, that did start to show a little bit of cracks kind of in the last month. But now if the market's starting to, price low rates, it feels like a good place to begin the conversation about stock picking.
Yeah, I think housing's tougher than it's been for the last few years. Again, I wonder if what we saw last week was short covering as opposed to, projecting lower mortgage rates, because the size of the move in the builders was much larger than you would expect, given what happened to the 30-year yield. As I say, I think that multifamily is entering a bear market, and single family, I don't think the builders make a lot of sense at current prices. I wouldn't call them shorts. I wouldn't call them longs. To me, it's kind of a not long. I'm not sure that the potential upside is really compensating you for something going wrong. Because generally, for most of the last 15 years, I've liked housing, and I feel less positively about it than I have done over most of that period.
And does that extend generally to cyclical categories, Mike? Or how about the more stuff that, the stuff that's very tied to the economy?
No, I think the economy is okay. I think multifamily real estate is a special case.
Okay.
And I would treat that as if it was in a bear market. And I think single family, I don't think there's anything terrible happening, but those stocks, although they came off a bit in the last few weeks, they're still quite expensive given current levels of activity. I think there are, no, I'd say is there's other cyclical portions of the economy that look more interesting to me than housing. Housing was the great trade of 2023 when a lot of the cyclical stuff lagged. And it's not been a great place to be in the first half of the year. I think there's still cyclical equities both within the U.S. and particularly outside the U.S. that make sense.
Okay. Talking about outside the U.S., I'm looking at your note with a lot of China analysis. Mike, maybe worth closing on that subject. Does that trade make sense to you right now?
I'd rather be long Japan than China, but I think, China looks like a part of the world where I think both internal and external sentiment is so poor that even a modest improvement is going to have a quite large positive reaction by the equity market. The biggest issue in China, I think, is the intransigence and I would say incompetence of the Xi administration, or maybe their goals are simply not the same goals that I have as an equity market investor. But they have yet to come up with any sort of interesting radical stimulus plan. It's still like this sort of salami slicing of small cuts to the reserves and small cuts to policy rates. If they were to do something more radical, such as, use the PBOC's balance sheet to start to mop up some of the bad credit sloshing around, or forcibly devalue the exchange rate, well, then I think you'd have something to get quite excited about. But as I say, I think it's okay to have a modest exposure to China right now. But it's, you haven't yet definitively turned the corner.
Okay. Great to catch up, Mike. Thanks a lot for the analysis.
Thank you.
Absolutely. Michael Shaoul, portfolio manager at the Ion Macro Fund. All right. Some good thoughts there as we try and dissect bond market action, stock market action from the last week coming into this one.